one of India's best-known value investors, Ramdev Agarwal, to talk about the art of creating wealth. Thanks very much, Mr. Agarwal, for joining us on the show. My first question to you is, I want to really start with one of the first principles that you've talked about, which is in order to start making money, you need to know how money was made in the past. Now, I want to ask you this because no two phases of a stock market or an economic cycle are the same. So how do you really project that onto what is happening today in the current environment?
So that particular context is in terms of countries, you know. So what happens is every country has a different businesses which make money because of, say, Saudi Arabia has a lot of oil and gas. Right. So one type of industry will make money. Whereas in India, it's much more consumer focused. I mean, we don't produce so much of oil, but oil processing company might do very well. Or say tech companies are, so Saudi Arabia doesn't have tech, but we have a lot of tech. So, you know, every country has a different set of companies, different set of businesses which will make money. So first, it's worthwhile to go and study in last 10-15 years which are the businesses which are big and make money in India.
Okay.
So India or for that matter any country. And once you have got some idea, okay, banking makes money, tech makes money, pharma makes money, consumer makes money, then okay, now I have a broad idea. And now let me look at the companies.
Okay.
So utilities don't make money here.
Right, right.
For some reason, utilities infrastructure don't make money, though we have the world's biggest deficit out there. So should I bother about these companies? I should be skeptical. Why they are not making money? Despite the opportunity is big. You run 200,000 megawatt power plants, yet there is no power company which is some $10-15 billion here except for NTPC.
Right.
So there is some reason behind that. You know, regulatory reasons or whatever. So before you start investing, you have to be very clear where to play.
Correct, right. So how does a non-professional investor start his journey towards investing, assuming he wants to manage his own money? Because A, it is very time consuming, and B, it can be quite expensive. Any mistakes, in fact, can be quite expensive. So how does one do that?
Yeah, so he has to pay his tuition fees, okay?
Right.
And tuition fee comes by way of mistakes. So when he is at early stage, say if he is investing few lakhs rupees, few thousand rupees. So first mistake he makes on a, say, a lakh rupees portfolio, if he loses 10,000 rupees, that will be his best, cheapest possible tuition fee.
Right.
Okay, but 10,000 is like a 10% of his portfolio. He will feel very, I mean, he'll be awake whole night if his 10% of net worth is gone. But the lesson which he is going to learn for that 10,000 rupees is going to be lifelong. So in investing at least, there is, I mean, of course you have to keep reading books, blogs, magazines, newspapers, yes, but on top of it, how do you internalize? What really makes you understand things is that when you commit mistake and you are being punished by the market.
So what are the main principles that you follow or that you guide towards when it comes to investing?
See, investing is about frameworks. So how to look at competition. So if you have read Michael Porter and his 2-3 books, Competitive Advantage, Competitive Strategy, you'll get a very good formal idea of how to look at competition.
Okay.
Now, what you learned in the book, you have to practice it in the actual ground.
Right.
So once you start doing that, you'll realize that there are a lot of insight in that particular framework. Everybody doesn't use that particular framework. So when you use it and you are master of using it, you make a lot of money. You are able to understand the prospect for the company, not only currently, but what could happen in the future, much better than the market or your competition. Okay. All these things, they come to tell you that what is the value of particular company. So it's investing at the end of it is value price gap, which is margin of safety. You have to arrive at huge margin of safety between price and value. Now price is there every day.
Right.
Okay, value is the one thing you have to find your own process. And left, right, you know, you have to find your process to figure out what is the approximate intrinsic value of this company.
The 4 pillars that you have talked about are QGLP, so quality, growth, longevity and price. Now, aside from that, how much importance would you give to something like innovation? Because if we look at the telecom sector, for example, we cannot possibly expect the kind of growth that we've seen in the past unless there's some major innovation that comes into it. So how much importance would you put on innovation per se?
Yeah, so if you look at QGLP, QGL is part of the value assessment and P is the price.
Right.
Okay. Now, in the Q, the first, there are 2 parts of Q, quality of business and quality of management.
Right.
When you look at quality of business, you have to bother about the whatever matters to that business.
Okay. Okay.
You have to, so when you talk about telecom business, anything to do with technology, you have to be very, very much on top of the subject that what can happen in next 5 years, 10 years or 15 years. And that of course includes the innovation in that particular field.
Right, right.
So earlier telecom was a wired business, then wireless. From wireless it is going to do a complete IP. All internet based it is becoming. So telecom and internet, I don't think there will be any difference at the end of it.
Correct.
So you have to be, and within IP, in the internet access, how exactly things are going to change. So I mean, those things are part of your business assessment, and when you want to see 10, 15 years, 20 years into the future, you have to be really taking into account all the impact of innovation.
Okay, so making large concentrated bets on quality businesses at the right price is something that's really easier said than done.
Yeah.
And often people may have as many as 50 different stocks that they want to bet on. How do you really zero in on the right stocks?
At some point of time, till about 94, 95, till I read Buffett, I was clueless about the quality. Then he started talking about quality franchises and Gillette and Coca-Cola, American Express, those kind of things, Seas Candy of all. So that we started learning about the quality of businesses. So clearly you have to understand quality, size of the opportunity, competitive structure, and then at some point of time realize that this business, and then you have to also throw what is the understanding of future of Indian economy.
Right.
So like we call it India the next trillion-dollar opportunity. So the growth in India, I mean at one level is, I mean you can see growth for next, 25, 30 years.
Yes.
I have seen in my own eyes what has happened in last 30, 35 years. I don't think next 30, 35 will be less exciting than last 35.
Right.
So I think India has a tremendous growth potential from here. Put that with all other understanding of competitive structure, quality of business, quality of management, what is the mathematics of growth, how this entire thing adds up to creating a particular size of value, and what price you are paying.
Correct.
So what happens is that you are able to take this concentrated bets not individually, you do it in the portfolio.
Right.
So the portfolio approach also helps you take a concentrated bets.
Right. I want to pick up on the point of price and valuation, because more often than not when all the other boxes are ticked off, the price tends to become very expensive. So how do you decide that the stock at a particular valuation, even though it's very expensive, is still worth buying? Page Industries, for example, in 2011, it was at a certain price and which we thought was very expensive. Now today the same stock is still 5 times from those levels. So how do you make that assessment really?
Yeah, see, buying is much easier. When I looked at Page, I mean we bought Page in when it was about 1,000 crores or even smaller than that. So so buying is very, very clear. The issue is when these franchises are becoming bigger and are popular,
right,
and known to the whole world, that even it is being asked here. So clearly these stocks are moved. So now at what level to say this is the value price gap is just the negative. So value is less and price is more. So one of the thought process, that one is that clearly you have to look at the growth rate,
okay,
quality of franchise, growth rate, and longevity of growth rate. So long as you see the growth going at about 25-30% for say 5 years, 7 years, you should not be in too much of hurry to sell these stocks. Typically because of the quality and very good recent past, you get a lot of time after the company has slowed down to sell it at almost the top price. That's been my experience. So long as the franchise is very high quality.
Right. Right.
So you don't try to sell too soon when the growth momentum is on.
So the consumption story is still yet to play out possibly, but as far as these FMCG and consumer stocks are concerned, these sectors, do you think there is time to enter this space at these current valuations?
Yeah. See, I think as the economy goes from say currently 2 trillion to 4, 5, 6 trillion, I mean in 2025, we are betting for at least 2025, next 10 years.
Right.
If you want to do any valuation of these stocks, at least you have to talk about 2025. So in 2025, you could be anywhere between 4 to 6 trillion dollar kind of a market GDP. Now in that situation, the companies which have a high entry barriers, those consumer companies will simply become very, very large. you know, and there will be a consumption all over, not only the urban, you know, metro towns, but tier 2, tier 3, tier 4, and thanks to internet, now even the selected rural guys, they will be consuming what you are consuming here. The gap is going to be flattened by internet. So upcoming consumer boom is going to be big for the companies which have a huge entry barrier, and the companies who are the companies which have the which have fancy valuation, the companies which have entry barrier in that segment.
Right.
So the size of the opportunity is big for that category.
Right.
There is, I mean, there is no possibility of digitization of that particular category. Say undergarments, I don't think it will be digitized.
Right.
Okay, and that's a category where brand value has some meaning. You know, so as the consumption of that particular product goes up, and the size opportunity is big, and entry barrier is very high for any new person to come, I think it will be a very interesting thought process to see how big can they become.
Right. So what about the Nestle story? I mean, given what's happened now, because as a stock, it's clearly a bought right stock. But in this current situation, does one sit tight or even possibly buy at these levels at this time?
Yeah. So clearly, these are you know, in the long-term story of any company,
Right.
these kind of moments do come. You know, unexpected from somewhere, this trouble comes. But I think Nestle is a clearly, I mean, bought right, sit tight. I mean,
Correct.
in fact, the test of sitting tight is now. So clearly it's there, and if you get it significantly lower price, definitely you must, you know, pile on more.
Would the same principles apply for the consumption story that we were talking about to the pharma sector? Because as far as, again, disposable incomes are concerned, they are again increasing, a lot of rising stress levels, which is giving rise to lifestyle diseases. But valuations are really expensive for pharma companies, even though there's a huge opportunity for them right now.
Yeah, so that's also a very interesting business, because there are two types of pharma. One is the domestic pharma, branded generics, and second is your exports of, I mean, to developed countries and actually all over the world, even to the developing countries. Now, in pharma, one of the themes which has done very well, Sun Pharma, Lupin and all, I mean, of course, they have made money in India. They made the first success in India, but their biggest success has been the exporting of pharmaceuticals, generic pharmaceuticals to US and other developed countries. Now, there is a concept of value migration.
Okay.
Values are migrating, values of the generic business is migrating from European companies, European and American companies to Indian companies, because India has the lowest quality, lowest price and highest quality. Our quality as good as what Europeans can give, price significantly lower. So obviously the business will come to India.
Right.
And it's a very large global opportunity and growing opportunity. So Indians have big opportunity out there. So all these companies are growing despite what their size is now. They're still growing 30–40%.
Correct.
And there is a lot of consolidation opportunity in the sense that a lot of marginal players abroad, they would be sold out to these guys. So that's a very, very interesting space.
Right. So the reason I'm stressing so much on price and valuation is because one of the points that you've mentioned is that how investing at exorbitant prices can be a source of value destruction.
I mean, you have to be very cautious of how much price you are paying. But because the price is looking a little high, or in last 4–5 years they have moved up by 300–400%, that doesn't mean that you should not be buying the stock. Okay. Even in the worst of the market, if the stock is very expensive, you should avoid, and in the best of the market, if the stock is cheap, you should not hesitate to buy.
The other question I had was with regard to holding cash, because to really make use of any opportunity, one needs to have some cash to be deployed. So what would your advice really be to investors as far as holding cash is concerned?
So you must hold cash till you don't get opportunity. But if you have opportunity, you should not hesitate in allocating full 100%. Because I don't advise anybody to leverage. So clearly, if you have an opportunity, you should not hesitate and put very significant portion of the portfolio into that. I mean, in PMS and all, we'll go as high as 15–17%.
Okay.
In mutual funds, we are not allowed to go beyond 8–9%. So, but we buy up to 8–9%, and that's how you are able to make a very concentrated strategy. So we have not practiced holding cash too much by way of strategy. But if somebody doesn't have any idea, there's no point in pushing the luck too much.
Correct.
You know,
Correct.
you must let it remain in cash till you get the next idea.
Let's talk about 100x stocks, whether it's Infosys, Eicher Motors or Lupin. I want to ask you, did you view them as 100x stocks at the time that you invested in them?
Obviously, first thing is, let me qualify, I don't have many 100x stocks except for one.
Okay.
So, and 100x happens, you know, 100x is about thinking big. Don't think incremental. Basically 100x means nobody knows in investing, nobody knows one buys that it is going to be 2x, 20x, 100x or 1000x. See Infosys, the guys who got it in IPO, there are some guys still around. It is more than 6,000 times, from 31 crores to 3 lakh crores. So what I'm saying is that it is very difficult to figure out when you're buying that you have hit upon a big one. You get a sense that yes, so QGLP takes care of, if you do SQGLP, which is part of that S is the small and unknown.
Right.
When you do a small and unknown and then QGLP filter, you have a full recipe for that. But when you are sitting with that stock at that point of time, to see the next 20 years what can happen to the business and what can this businessman do with that and what will be the valuation is very tough.
So on a broader level, do you believe that the process of wealth creation has changed dramatically today versus what it was in the pre-2008 period?
No. In fact, for last 200 years probably it is same, and next 200 years also going to remain same, which is that margin of safety. If you are able to buy what is worth 100 for 20, 30, 40, 50, I think you're going to make money. That's the basic rule of the game. I mean, value price gap has to be in your favor.
Right. But as far as investors are concerned, do you think that people have become more cautious or more averse to taking risks?
No. See, investors have the same two sentiments, greed and fear. So from 2008, after the collapse, till 2013, they were in the grip of fear. Then from, I think, February, March, and more particularly after the election, people started slowly coming out of the fear, and fear is still melting down and confidence is slowly coming back. So now they are still not in the mood of greed, but definitely they are giving up on the fear part of it. And then it will gain momentum and finally they will become very greedy. And then the market will peak out at some point of time, because we still don't see any IPOs, we don't see, so lot of parties, lot of analysts, that's not there. So clearly right now there is more mood of buyback, withdrawal and those kind of things. So I think investors, they are always moved by these two sentiments.
So what is your own personal motivation for investing? What really drives you even now after so many years?
Yeah, so one is of course the urge to make money. Second is that when we are setting up corporation, I mean the Motilal Oswal, so we wanted to make it a machine which is going to outlast us. So these two ideas have come together. So let's make a corporation which does the business of investing.
Right.
So bring investing skills and create an organization where the highest order of integrity is there and highest competence is there in investing, and that's the whole effort, and that's what keeps driving me.
Right. Do you believe in spreading out your investment bets across several companies, or placing a few concentrated bets on strong businesses like Warren Buffett does?
Yeah, so clearly I mean, it's all learning from him only. So we have done very concentrated bets. So like our mutual fund products will not do more than, I mean, we typically in any other portfolios, we don't do more than 20 stocks. And that more or less takes care of all the diversification. So not more, and in fact it is less than 20, 17, 16, 12, 14, those kind of things. So clearly it's a focused strategy and buy and hold strategy. Not only you have less stocks, you also don't churn it. So it's a very focused and buy and hold kind of strategy.
Right. So do you have any, in terms of market cap, any preferences in terms of small, mid or large caps?
Personally, I don't like this market cap, what do you call, constraints. Yeah, because in this global economy, $100 billion company can also be, can also grow at 5 times, and a $1 billion company can collapse by 90%. So I think there are businesses where things cannot go beyond $1 billion. And there are businesses where I think $1 trillion is also small. So, I mean, you have to be cap independent in investing.
What books or authors, I mean, for people who are interested in learning about investing, who want to read, what are the books and authors that have inspired you that one can sort of look to?
Yeah, so clearly Buffett has been, and Buffett letters, BerkshireHathaway.com, all the 77 till 2014 letters, they are the best and the most exciting source of wisdom about investing, about running businesses, whole lot of stuff. So that's very big one, and the most, I would say, sought after. Second is a book called Common Stocks, Uncommon Profits by Phil Fisher.
Okay.
Then you have Competitive Strategy by Michael Porter. Then there's a book called Value Migration by Adrian Slovinsky.
Okay.
That's a very, very powerful book.
So investing is a lot about psychology. How would you advise investors to overcome psychological fears when it comes to investing in the stock market? I mean, for example, in 2008, everybody keeps saying if I had invested, I would be sitting on so much money right now. But how do you overcome that psychological aspect of investing?
Psychology also investing in equities,
yes.
Basically. See, because these fluctuations keep happening. So market doesn't know that you have bought the stock. So market will behave in its own way. So
right.
you have to learn to deal with the fluctuation. So don't focus too much on the price. Focus on the company. So if you are 99% focused on to what the company is going to do, and you are confident that the company today which is making it, say Nestle, today Nestle has all the problems, whatever. Okay, so should we focus on stock price fluctuation or should we focus on the business? Now today they are making about 1,000 crores profit before the crisis. Now 10 years henceforth, hopefully everything will be by that time sorted out and there will be normal this thing. Will they make 3,000, 4,000, 5,000 crores profit, or will they be absolutely small? Those are the things one must focus on. You know, so companies, how the companies are going to do, that's the call people should be focusing on, rather than yesterday price was 100, today it is 80 and 85 and all that. So because the price is emotional, value is unemotional.
Right.
You know, so focus on the unemotional aspect of it rather than emotional aspect of it. And once you have figured out this is the underlying value, then price is there for you to check. If price is favorable, buy. Price is unfavorable, and if you have one stock, you can sell also.
And finally, so what is your one investment philosophy that you follow that you would advise investors?
Yeah, so absolutely don't be fearful of investing in equities, particularly Indian equities. And if you don't know the game, take professional help. Develop a relationship with one of the managers and come confident into the market. There's a lot of, I mean, what we have seen in the past, multiple times of that is waiting to happen in the future.
All right. Thank you very much, Mr. Agarwal, for joining us.